Let's go to Kevin Green. Let's talk some charts. Looking at the ranges here, maybe intraday, kind of first KG, looking at yesterday's session and a little bit of the weakness that was kind of creeping in around the edges of the market. We're trying to take that back as we start at 60.67 on SPX.
Yeah, when you're looking at the market breadth, it's actually looking pretty healthy. Around 80% of the stocks in the S&P 500 are up in the session so far here, Oliver. And I only think there's only one sector that is down for right now. Let's see if it's going to be able to hold. But on an intraday basis, we actually have a pretty wide range of levels just based on some of the volume that we've seen. Now, obviously, the volume is going to be light going into the open for the S&P 500 options here. But the first area of resistance or first challenge area that we could see is actually 60.65, which we're pretty much testing that here right now. And if we do kind of get a break to the upside, maybe we have a little bit of a melt. You're starting to see a lot more calls being sold at the 60.80 level at the first level. And then the next one is going to be 6100, which obviously you want to be able to try to get back there. But on the downside, if we were to fade, and we do have some of the mega cap names kind of fading off here a little bit, the 60.30 is going to be your first area of support that you would like to see some buyers kind of stepping in just from a positioning standpoint, which is basically where we closed at yesterday and on a level that we kind of highlighted yesterday too. And then we actually do see some flows going into the 6,000 level for the put side here. Around 3,500 contracts have already traded at the 6,000 level for the puts. We're in the green for right now, but something just kind of keep on your radar. But that's actually a pretty wide range compared to what we've seen over the last couple of trading sessions, where we've only had maybe 20-point ranges to the upside or downside that for the most part have been able to hold. Now we actually have something that's expanding of 75, 85 points to the upside or downside for the S&P 500. Let's see if that's going to come to fruition. And if we do have this vol crush taking place in the VIX, that could be one of those catalysts where we do see some buyers trying to step in and take this market higher. And maybe we did have a consolidation pattern that took place over the last couple of trading sessions.
Okay, so it would be nice to clear this area between 665 and 670-ish to kind of really break past that kind of Monday level that still might be some resistance, it seems like, is kind of the message.
Yeah, yes, definitely. So this is going to be, once again, kind of that first hurdle. Now, we have to keep in mind, too, the economic data that we have for today. We had CPI, which obviously came in line, which is bullish for the market. We also have a 10-year auction. We haven't had one for about a month. So let's see what the 10-year notes are going to be able to do for today. If we do have enough, buyers stepping in there, if it's a very strong auction, that could be another reason that we have a catalyst to the upside. If we have a weak auction, that's where you could maybe see, some volatility kind of creeping back into the market. So keep that one on your radar. And then once again, kind of that downside move. I mean, we've had some pretty decent pushes to start the sessions over the last 2 or 3, but we have faded every single one of those. So it's not a given that this is going to be a strong market that's going to continue to rally to the upside. I think we have a long way to go for the remainder of the session to be able to make that assessment. If we kind of go back to the open interest side too, though, yeah. I mean, if you're looking at it,
tell me about the positioning.
Yeah, when you're looking at open interest, it's still 6,100 at the top end for positive gamma right now, and you're looking at 6,000 for the lower end. And yesterday we kind of highlighted from a technical standpoint the 60.30 level, and this was kind of going in to the open yesterday. If you kind of notice, that was actually an area of former resistance that turned into support around November 29th. And then the first trading session in December here. So you kind of have that level from a technical standpoint holding up, which is right above that 200 period 20 period moving average, which is the blue line there, which is sitting at around 59.95, pretty much 6,000. So there's a confluence of positions as well as technicals that kind of points to that 6,000 level being a very strong bounce area if we were to fade even today's move right now.
Okay. So looks solid, but obviously we took some damage both for the advanced decline line the past week and some of those stochastics. So there is some repair that needs to be done technically on the trend, but it shouldn't be too hard to do if we can just get some follow through. Looking at credit and bonds, KG, since we were talking rates this morning, I know you got a thought on that. Hit me.
Yeah, I just find it very interesting here, Oliver. I mean, when we kind of talk about these markets and what could actually create some cracks when it comes to equities as well as the economy, a lot of people actually look at credit spreads in order to do so. But when you're looking at the credit spread market, especially for high yield, which is once again going to be a little bit on the lower end of the credit scale, you're still actually seeing high yield credit spreads moving lower. Actually, it's at the lowest point that we've seen over the last 10 to 15 years here. So there's not really a sign when you're looking at fixed income, even though we're seeing the volatility within yields, especially when you're looking at treasuries, still at elevated levels. The spreads themselves are actually looking very tight. And until we actually start seeing that move to the upside, starting to hinge a little bit higher, I think that gives a lot of institutions as well as strategists out there a little bit more confidence that the market's going to be able to hold up at least for the first half of next year, unless they do see a change here. So this is something I'm keeping on the radar. Obviously, you can kind of see as we do see spikes and credit spreads going higher, meaning that liquidity is kind of drying up. That also kind of coincides with near-term pullbacks in the market. That's just not something that we have yet. And until we do, I think it's all systems go on the longer-term time frame when it comes to this bull market.
All right. Great. Love that. Good perspective. A nice fundamental case there for feeling confident in the economic picture with credit spreads as tight as they are. Thanks, KG.